Welcome back. You're watching HFO-TV, co-sponsored by AMF Capital, the Baljanik Law Firm, the Butler Exchange Group, and the construction firm J.R. Johnson.
Hi, I'm Greg Frick, partner at HFO Investment Real Estate, here again for HFO-TV. We're doing a Zoom meeting interview. We're about 90 days into COVID. It's the end of June. So again, we've trying to keep this medium going, and we can't meet face to face. So I want to thank Trent for meeting with us remotely. He's with Perkins Co, and we're going to talk a little bit about what we talked about. I think it was last quarter, about some of the changes in the tax code, and then we got the corporate activity tax, which passed last year, but people are kind of trying to get their arms around it with that going on with COVID and all that. So again, thanks for taking the time out. And again, we are doing this remotely. We're not sitting in the same room, so we are practicing safe distancing here. But we thought it'd be still valuable to get information out to our clients in the market. So again, thank you for taking the time to do this. Maybe give a rundown on what kind of the corporate activity tax, also known as the CAT tax, it took effect in January. Has there been more of some certainty surrounding that and how it's affecting multifamily owners, or kind of where's changed from when we spoke last time?
Yeah, when we spoke last time, I think it was towards the end of February, and they were still rolling out their temporary rules, and the plan at the beginning of the year. So remember the corporate activities tax went into effect on 1/1/20,
right?
Which there was scant rules before then. Started rolling out some temporary regulations. The plan was in January, February, March to roll that out. That got delayed a little bit with the COVID situation, but we do have a number of not only temporary rules that have been released, but also final rules. And so for the most part, I think we know where we sit with a lot of things. The answer isn't necessarily the greatest answer. They've kept things very broad in a lot of ways. As it relates to multifamily, rental real estate in general, and multifamily as well. A big question was, are we going to have any deduction? This is mostly a gross receipts tax,
right?
Based upon your Oregon properties, essentially. So if you've got properties that you're managing or that you own outside, Washington, Idaho, California, outside of Oregon, we're going to exclude those. It's really the Oregon sales, and there's only two potential deductions, a cost of input and a cost of labor. And so we got a little bit more that, the cost of input is really selling tangible goods, an inventory type deduction. So
which we don't have a lot of in multifamily.
Yeah, we don't have that. There was a little bit of holding out of hope that we were going to be able to squeeze some depreciation in there. I think that door is pretty much closed, and so then we're left with the cost of labor deduction. And there, what we're really looking at is, do we have direct W-2 employees for either your property or as part of a potential unitary group that you may be filing in. But in a very common situation where you're paying a property manager to manage the property, collect the rents, do everything, they have their W-2 employees. They're not considered your employees. So
so it has to be a W-2 employee for the entity that owns common entity,
common law employee. Yeah.
Interesting. Okay. So so if you've got third-party management, so to speak, and it's their W-2 maintenance people, on-site staff, you're not going to get that employee deduction.
Correct. Yeah.
Gotcha.
Yeah. I think the biggest area that we had some questions that I think we got as much answers as we're going to get relates to, I mentioned Unitary Group.
Right.
So they've written that very broadly in the code as to what they mean by a unitary group. And so the way that they've written it is you have to meet two different tests. There's the group test means that you have common ownership of at least 50% in multiple businesses. So, it could be you and I, Greg, we have I have 1% of a building, you have 50% of a building, and then in another one, you've got 26 and I've got 30. Combined, we have more than 50% in both.
Got it.
So that would at least fit the unitary group definition. There's some.
Now, is that unitary group going to put me over the threshold because what was the threshold for the CAT tax is it?
So it's $1 million.
Got it. Okay.
$1 million. So very likely it's going to in a lot of situations. The unitary group doesn't automatically mean that we're going to have to combine them, because then the second one is what's called a unitary business.
Got it.
Test. That also very broad. What they've talked about as being a unitary business is basically, for real estate, it's centralized management, HR, accounting, administrative type tasks, that if you're sharing that amongst those businesses that are in the group, then they're going to say that you've got a unitary business, and they're going to pull them all together.
So that would be something like somebody that owns 5 or 6 buildings. Maybe they have single asset LLCs on each building ownership, but they've got a centralized company, so to speak, managing or doing HR, and they're going to put those all together.
Yep. The example that I had with you and I, if the one that you had more ownership in, you had your team doing the accounting and doing the management of that, and then for the one that I had more ownership in, I had my team doing the accounting and the management and the HR. Then we'd be separated and we wouldn't have to pull them together. But if it was your group that was handling all the back office and management of it, then I would get pulled into your group.
So you would get pulled into my group, and then got it. Okay.
Yeah, and so it's really looking at that, who's managing, who's handling those administrative tasks. They left it pretty broad, broader than what we were hoping there. I think they're really trying to leave as much room out there to raise revenue on this, to be completely honest.
So on something in our world, we have a lot of, there's a lot of groups that own via partnership, and you and I are a partner, and we own a building together, and you're a partner with somebody else. And I mean, are they going to look at your slices of you're 25 with me, you're 25 with somebody else, together your percentage is over the $1 million on the gross revenue? Does that mean you're getting hit with that, or does it depend on
So when we fall into the unitary group issue, which is very sticky in terms of trying to get all that ownership pulled together and figuring all that out, it's going to pull in a lot of people that may only have I might only be invested in one building, and that building's got 500,000 of rents, and so I think I'm fine. But now it's getting pulled into all of your 500 properties that you have, and so now our $500,000 of rents are subject to the tax in that situation. One area for opportunity here, a very common structure that we see with a lot of clients of ours is having their own management company do the property management. So they own a bunch of properties, they're paying into their management company, they're paying employees. In that situation, they're at least going to have a labor deduction, since they'll be able, since that management company will be part of the unitary group, and so they'll get a little bit of a benefit there.
But that entity, the entity where you're 10%, I'm 20, and somebody else is a 70, and we hit over that $1 million threshold, there's going to be that corporate activity tax for our quote entity that we're together in.
Correct.
And then if you and I own another one that pulls us in, that may get pulled in as well.
Correct. And they left it very broad in terms of for every group, they can choose who's going to be the reporting entity for paying the tax.
Got it.
And then they're going to have they're left on their own own devices, essentially, to collect that from the various properties if they want to charge it back, essentially.
Got it.
Or if one entity just wants to pay it all and incur it all, they can. But it's the state's less concerned with that, and that's going to be a little bit more of a back office type.
Kind of more on your guys' shoulders as to who's going to be reporting it and who's going to
Yeah, a little bit, yeah.
Yeah, I mean, they just want to see the number come based on the gross, and that's where it's got it.
Correct.
Is it unusual in you've been doing this for a long time too? I mean, I know there'll be tax measures passed and all that, and then you get kind of regulations in the year that it's happening. I mean, has this been slower than normal? I mean, is it always, we're in June now, and there's still, I mean, it makes it tough for you guys and CPAs in terms of tax planning and.
Yes, this is we thought that it was bad when the Tax Reform Act, the big Tax Reform Act was passed in late December of 2017 for 2018. There we had a full year before we were really applying it. I mean, this is a tough one for us to have to pick up on the fly. And it's been tough. The state's been, right there. They've been taking feedback, but from what I've seen, from the changes from the temporary to the final regulations that they've issued so far, they've made very little changes. And the kind of the big takeaway is I think they're trying to keep it as broad as possible to try to make sure that they're collecting
everything they can, and
they really are. And the sad thing or the difficult part of the tax is that we've been talking about it in terms of multifamily and real estate. There's one of the things they sold it on was being able to get out of state businesses. We're really a couple 2, 3, 4 years away from really starting to see more compliance from out of state businesses. It's going to be the local businesses that are really paying for this in the early years.
So what are you telling your clients in the commercial real estate world? I mean, are the things that they should be doing now, or is it in regards to this? I mean, not so much that you're like trying to not avoid it, but how do you, for reporting and all that? I mean, how are you guys handling that?
Well, so one interesting aspect of it is that the state has said that if you want to, you can pass this tax along to your customer or client. If you do, then you're going to basically pay additional tax on that tax that you collected. We have seen that there's been some contractual restrictions from it, specifically in AIA contracts that were in place, construction contracts that were in place at the beginning of the year, and this is not something that could be automatically added. And so we're seeing some changes into contracts and into languages for, well, to be honest, there hasn't been a lot that's been over the last few months that has been starting up new, but we're seeing that, for rental properties, it's a little tough in terms of how to pass that along, other than trying to build that into pricing and budgeting to the extent that you can.
Yeah, no, we have talked to some of the contractors and builders regarding kind of the trickle down from, the generals got this, then it comes down to this, to the sub, to the supplier, and this 1% tax ends up being, this is back before probably the regs, saying could go up to like 3.5% when it's filtered all the way through the system. So
yeah, the general contractors are among the groups that have been hit the hardest by it, and they're already working on pretty tight margins. And that the state is basically, it's unlike a sales tax or some other similar type taxes where it's really imposed at kind of the last level. Here, they recognized and they said, we understand this, and if you want to pass it along, you can. You just have to pay it on it. I think they're just looking at it as a way that it's going to continue to increase revenue.
And is there continue? I mean, I don't know, from a tax law, do industries, are they still pushing for clarification to try to, because I know when this first happened, I know the construction industry and the lobbying groups were talking about, do you understand, the way it's written, how this is going to affect? Didn't feel like that was the intention. I mean, do you see that when we're sitting here talking in February of 2021 that, hey, they've done some clarification and, from a construction standpoint, it's not going to be,
I'm not optimistic on that. And I've been in contact with a couple of attorneys that have been following this closely and have some people at the Department of Revenue that are, and so they have access to kind of the thought process and things like that. And that's where I'm getting some of my pessimism, if you will, is, just from conversations, they're moving forward without, the benefit of the doubt for taxpayers, if you will, or leniency that they're broad, trying to,
capture it all,
have as wide of a net as they can.
Okay. Okay.
So the biggest thing that we're talking about is, just understanding it for budgeting, trying to figure out when and how you can potentially pass it along through, to help your bottom line. For rental properties, it's a lot tougher than some other industries, honestly.
Yeah, but there's maybe the way in terms of structure with partnerships and things like that, how you're structuring that. And, I'm thinking about owners that have various partnerships all around and, allocated together, great, they hit that threshold, but, maybe, and then, so who gets pulled into that? So if people do have questions, feel free, you can reach Trent at the email below on the website. They can, now that there's more clarification. I know another thing that we talked about is the qualified improvements and bonus depreciation. So, what's new in terms of, of that situation? Or
and so this is as part of the CARES Act that was passed at the end of March. The big publicity as part of that was the payroll protection program that businesses were able to, the PPP that they applied for, the paycheck protection to continue to pay their workers, as well as the stimulus checks for individuals. That got all the publicity. There was some tax benefits that were also in that bill that was passed, and we got the retail glitch fixed from tax reform for the qualified improvement property, meaning the intention when tax reform was passed back in December of 17 was for that property to be 15-year, depreciable over 15 years, which would make it eligible for bonus.
Right.
There's a drafting error. They didn't write it in there correctly, and so it was stuck at 39 years, no bonus. They fixed that as part of the CARES Act, retroactive back to 1/1/18. So there's some options on either amending 2018 returns or filing a change of method to get caught up for that.
Okay.
Now, something that is important to understand with that qualified improvement property is that's for non-residential property only. So for multifamily property, we didn't have a change there. It's for non-residential property when there's either tenant improvements or.
So we're looking at office, retail, industrial.
Correct.
And multifamily falls into the resident, because a lot of times we hear people talk about residential from a taxing standpoint and thinking it's residential, single family, owner occupied, but this one, it's thrown into residential, so that's not a big effect.
Where it can have some effect is for mixed use properties.
Gotcha. Okay.
So there's a cutoff. There's a bright line test for mixed use properties where if more than 80% of the revenues come from the residential side, then it's considered a residential property.
Got it.
And so if it's more than 20% is from the commercial, then it's considered commercial, and they would be eligible.
And would it be considered commercial for the whole thing, or would it just be
the whole property?
Well, okay, it's okay, interesting. Yeah, because you look at those 5/1 kind of downtown core where you got ground floor retail, apartments above. It floats between 15 and 25 usually on the retail.
Yeah. And so for those properties that may have some tenant turnover, things like that, they'll have the ability to take advantage.
Okay, well, that's something to keep in mind. So for people with mixed use, but I guess the sad part of it, or the one thing, is for strictly multifamily, you're not kind of part of that realign. Okay, interesting.
Correct.
Is there any other kind of estate planning, tax considerations you're telling your clients who are heavily involved in real estate for doing things in 2020, or is it too early for looking at that?
Well, I know we are talking to clients about estate planning this year for a couple of reasons. Number one, with the CARES Act and with the PPP program, it was a significant outflow of cash for the government. Where there's a lot of speculation out there that if there's a change in administration this fall, that there could be some changes in tax rates going forward, or at least in, various changes around tax. The low-hanging fruit, if you will, would be increase in the estate tax. So, utilizing 2020 while we still have the high $22 million exemption is, I think a lot of people are really looking into that. The other thing that, we haven't actually seen as much of as we were expecting, 6 to 12 weeks ago, was some depression in values. We've seen some utilizing lower values in 2020 compared to where we've been the last few years for purposes of gifting and moving things around in the estate. They luckily values haven't dipped so far as much as we've seen. We'd love, honestly, for that not to be as much of a planning tool, because that just means the values are sticking around more for our clients and for everyone. But to the extent that they do dip further in 2020, we're expecting to see some families take advantage of that on the estate side.
Of the gifting and doing that. Gotcha. Yeah, we have not seen that heavy on multifamily yet. There haven't been a lot of deal points. It will be interesting what happens, when we, 3 months from now. I think more so on, like we've talked about, retail and office. If you've got substantial percentage of deferral, if you said what's the value based on, my tenant paying my office tenant or retail tenant paying 50%, what does that do on value? Multifamily, we haven't had, there's been a little bit, but nothing substantial, and so it'll be interesting.
Yeah, especially here locally. I've been hearing the same things where, the multifamily's been, pretty strong. Maybe a little slow on the pay, but
knock on wood.
Yeah, knock on wood that continues. There's a lot more volatility in the retail office.
Well, I want to thanks for taking the time to meet today. I know it's it's an interesting time for all of us, but with what's happened. I think big thing you mentioned was the clarity on the activity tax locally, Oregon, and then kind of the changes with the more guidelines on the federal side. I think people need to, maybe use this year as one to really look at doing some estate planning, and at least, get with your CPA if you don't have a qualified CPA. Perkins is great. We've done a lot of work with them as well. So again, Trent, thanks for taking the time to do this, and I'm sure
I wish I had better news on the cat tax, but it is what it is, and so all we can do is try not to have big surprises come next April.
Well, I'm sure we'll be sitting talking about for owners in Multnomah County. There's the one there too. So that just we'll discuss that here next quarter with you, I'm sure. So
Alrighty.
All right, thanks. Have a good one. Hope everybody's safe. We'll see you soon. And thanks again for joining us on HFO-TV.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.